Hello, hi friends, good morning. Now let's start our revision relating to direct tax capital gains chapter. So previously we have discussed about direct tax introduction chapter, in which we have discussed about the various definitions that are relating to the relating to direct tax income tax 1961, and various traits that are applicable to the various types of various type of persons. Person definition has been given under 2 subsection 37 to 2 subsection 31. So in the similar manner we will discuss about the capital gain provisions. So capital gain chapter, in case of capital gain chapter, every type of head starts with the section charging section. What is the charging section of capital gain? Capital gain charging section is section 45. So section 45 subsection 1 of the Income Tax Act 1961 says like this: any profits or gains arising from the transfer of the capital asset during the previous year is chargeable to tax under the head capital gains in the year in which it is taxable in the year in which the transfer took place in the hands of assessee. So here there are some of the important points, there are important words you need to take into consideration. First one is transfer. What is meant by transfer? Transfer has been defined under 2 subsection 37 of the Income Tax Act 1961. Transfer, it is an inclusive definition. Transfer includes sale. Transfer includes sale. It includes sale. It includes relating to immovable property. It includes transfer of or enabling enjoyment of the property. It includes possession of immovable property, and it includes extinguishment of rights, relinquishment of rights, and it includes transfer includes conversion of the stock in trade into capital asset. Transfer also includes redemption of zero coupon bonds, redemption of zero coupon bonds, and various other categories. Redemption of zero coupon bonds, all these comes under the definition of transfer. This has been defined under 2 subsection 37 of 2 subsection 47 of the Income Tax Act 1961. We have understood what is meant by transfer. Now comes to second part of the charging section, that is capital asset. What is the definition of capital asset? Capital asset has been defined under section 2 subsection 24. Under 2 subsection 14 has given the definition of capital asset. Capital asset means tangible property, intangible property. Tangible property or intangible property which has been, whether it has been utilized or whether or not it has been utilized for the purpose of business or profession or not. And it also includes securities that are held by the foreign institutional investor or foreign portfolio investor, and it also includes capital asset. Capital asset will also includes any capital asset will excludes what? Capital assets will excludes the following things, that is personal effects of the individual. It excludes stock in trade. It excludes in excludes definition. It excludes means it includes what? It includes archaeological collections, drawings, paintings, sculptures, archaeological collections, any other work of art, and it excludes what? It excludes capital asset. So it includes what? It includes here stock in trade. Stock in trade does not include any securities that are held by the foreign institutional investor as a stock in trade. It also includes what? It also includes okay. As of now, these will be included in the definition of capital asset. Now let us move to third definition, that is transfer of capital asset during the previous year. Previous year has already defined what is the definition of previous year. Previous year has been defined under 2 subsection some has been defined under the Income Tax Act. Previous year has been defined under the Income Tax Act. section 2 it has been given the definition, no? And previous year here what is a period of holding? Period of holding definition has been given under 2 subsection 42 capital A. 2 subsection 42 capital A gives the definition of period of holding. Period of holding will consist of 3 types of buckets. First bucket is relating to 12 months, second bucket is relating to 24 months, third bucket is relating to 36 months. If first bucket is related to 12 months, second bucket is relating to 24 months, third bucket is relating to 36 months. If the 12 months bucket consists of 5 category of items, that is listed equity shares and preference shares. Next, units of equity oriented mutual, listed equity oriented mutual funds, units of UTI, zero coupon bonds, and it also includes listed securities on recognized stock exchange. These 5 items will be included in the 12 months bucket. Means if the period of holding is less than or equal to 12 months, it is considered as short-term capital asset. Short-term capital asset has been given under definition of short-term capital asset has been given under section 2 subsection 42 capital A and 2 subsection 42, and the gain or loss, the profits or gains arising from the transfer of short-term capital asset is considered as short-term capital gain. Short-term capital gain is given under section 2 subsection 42 capital A, and this gain is taxable at the rate of normal rates of tax. If it is other than listed equity shares or listed equity oriented mutual funds, if it is related to listed equity shares or listed equity oriented mutual funds, it will be taxable at the rate of 15% flat rate under 111A, and there is no expenses that will be allowed against this. There is no other expenses deductions that will be allowed against this income, and it will be again obviously health and educational expenses at the rate of 4% will be applicable. Next, in respect of any in respect of 24 months bucket, if 12 months bucket only, if the period of holding is more than 12 months, here the period of holding is more than 12 months, then in that situation it is considered as a long-term capital asset, and long-term capital asset definition has been given under 2 subsection 24 capital A, 2 subsection 24 and 2 subsection 24. And what is meant by long-term capital asset? Long-term capital asset, if the period of holding is more than 12 months, it is considered as long-term capital asset, and any profits or gains under 2 subsection 24 capital A, any profits or gains arising from transfer of long-term capital asset is considered as a long-term capital gain, and this long-term capital gain is taxable at the rate of 20% or 10% as the case may be. It is 20% in respect of other long-term capital gain. If it is 10%, if it is long-term capital gain arising from transfer of listed equity shares and listed equity oriented mutual funds, there is an exemption limit of 1 lakh rupees. If it is up to 1 lakh rupees, there is no tax that is required to be paid. If it exceeds 1 lakh rupees, on the excess amount only 10% concessional rate is applicable, and health and education says that 4% is applicable, and no other deductions under chapter 60 are allowed against this income. And long-term capital gain tax is long-term capital gain income can be set off against long-term capital gain loss only, and short-term capital gain income can also be set off against long-term capital gain loss. But here in respect of short-term capital gain loss can be set off against short-term capital gain income, only, but short-term capital gain loss cannot be. Short-term capital gain loss can be set off against long-term capital gain income, but long-term capital gain loss cannot be set off against short-term capital gain income, and it is intra-head adjustment and inter-head adjustment, section 71, section 70, section 71 as the case may be. And here brought forward, here the long-term capital gain loss can be brought forward to 8 assessment years, carry forward to 8 assessment years, and short-term capital gain loss can be carried forward for 18 as 8 assessment years. Next, in respect of this is a category, and third one is 24 months bucket. In respect of 24 months bucket, what are the items that are falling under the 24 months bucket? 24 months bucket consists of unlisted shares and securities, and it also consists of land or building or both. Falls under 24 months bucket. If it is less than or equal to 24 months, period of holding is less than or equal to 24 months, then it will be considered as a short-term capital asset, and any gain, profits or gains arising from short-term capital asset is short-term capital gain, and we have already discussed the relevant sections that are applicable for short-term capital asset. In the similar manner, any profits or gains arising from period of holding is more than 24 months, any profits or it is considered as long-term capital asset, and any profits or gains arising from transfer of long-term capital asset is long-term capital gain, and in respect of long-term capital gain, relating to land or building or both, section 50 or section 50C comes into play where section 50 or section 50C or section 50CA will comes into play. And in terms of long-term capital gain, exemptions under section 54 to 54, 54A to 54 to section 54 GB will be applicable as the case may be, depending upon the type of instrument in which the assessee has made investment, type of asset or type of instrument in which assessee has made investment. In the similar manner, to 36 month bucket consists of any other asset, means those assets that are not falling under 12 month bucket or 24 month bucket will fall under 36 month bucket. If it is less than or equal to 12 less than or equal to 36 months, it is short term capital asset, and any gain or profits or gains arising from transfer of short term capital asset is short term capital gain. And here if it falls under the long term capital, if the period of holding is more than 12 months, more than 36 months, then it is long term capital asset, and any profits or gains arising from transfer of long term capital asset is long term capital gain. So this is in respect of period of holding and types of capital assets, short term capital asset and long term capital asset, and gains types of capital gain, short term capital gain and long term capital gain, long term capital gain. This is section 45. This is section 45 subsection 1 charging section. Now we will move to the second part. What is second part? Generally, we will move to second part. Second part is what? Second part is first as per charging section, there are some of the exceptions to the charging section. What is charging section? Charging section means any capital asset that has been transferred during the previous year. Any profits or gains arising from the transfer of capital asset during the previous year will be chargeable to tax in the year in which it has been transferred. But there are certain situations where the capital gain is taxable not in the year of transfer, but in some other year other than the year of transfer. What are the exceptions? Exceptions are given under section 45 1 capital A, or as follows. Section 45 1 capital A. Section 45 1 capital A is what? Section 45 1 capital A deals with the capital gain arising from the insurance claims that have been received on damage or destruction of capital asset. Here, if any insurance claim that has been received on damage or destruction of capital asset will be chargeable to tax in the year in which such insurance claim has been received or insurance proceeds has been received, but not in the year of damage or destruction. This is exception. This is overriding the charging section, overriding the provision of charging section. Here, what are the causes of damage or destruction? Damage or destruction can be due to four type of reasons. It can be due to flood, typhoon, hurricane, or it can be due to earthquake or any convulsion of nature, or it can be due to strike or civil disturbances, or it can be due to riots, strike or civil disturbances, or it can be due to combat of the enemy, or it can be due to fire accident, or it can be due to any other accidental fire happenings. So the asset can be damaged or destructed. So once the asset has been damaged or destructed, then in the situations, here we have to calculate the capital gain. How we have to calculate the capital gain? So computation of capital gain, it consists of 3 parts. First one is we have to find out what is full value of consideration. Definition of the full value of consideration has been defined under 45 1 capital A as follows. The full value of consideration will include what? Full value of consideration will include the insurance proceeds that have been received on the damage or destruction of capital asset will be included in full value of receipts. Insurance proceeds can be received either in fully in cash or fully in cash or fully in kind, or partly in cash or partly in kind. If it is fully in cash, entire monetary consideration will be included in full value of consideration. If it is fully in kind, fair market value of such non-monetary consideration will be included in the full value of consideration. If it is partly in cash or partly in kind, then in that situation, part of the monetary consideration that has been received will be included in the full value of consideration, plus fair market value of non-monetary consideration that has been received will be included in full value of consideration. Will be included in what? Will be included in full value of consideration. From this full value of consideration, we have to reduce the cost of acquisition. What is cost of acquisition? Cost of acquisition or indexed cost of acquisition. Here, cost of acquisition is the purchase price of capital asset that has been incurred by the assessee will be the cost of acquisition. If it is a long-term capital asset, if it is long-term capital asset, means if the asset falls under 12 months, if the asset falls under 24 months or 36 months bucket, then if the period of holding is more than 24 months or 36 months, it is considered as long-term capital capital asset, and for long term capital asset indexation benefit is available. Indexation benefit is the long term capital asset, the cost of acquisition of long term capital asset has to be multiplied with indexation in the year of destruction divided by indexation in the year of purchase. Then we will get the indexed cost of acquisition. If there is any improvement that has been carried out by the assessee in the previous years, then that indexed cost of improvement will also allow for deduction against the sale full value of consideration. Here if the asset is held by the previous owner, then as per Manjula Jaisha case, the Supreme Court, the period of holding has to be considered from the period it was first held by the previous owner, and indexation has to be calculated from the year in which it was first held by the previous owner. Then we will get the capital gain. Capital gain can be short-term capital gain or long-term capital gain, depends upon the period of holding. If it is less than or equal to 12 months, or less than or equal to 24 months, or less than or equal to 36 months, then it is short-term capital asset and short-term capital gain. And if it is more than or equal to 24 months, or more than or equal to 36, more than 24 months or more than 36 months, it is long-term capital asset, long-term capital gain. And short-term capital asset, short-term capital gain will be short-term capital asset or short-term capital gain will be chargeable to tax at the respective rates, and long-term capital gain will be chargeable to tax at the respective rates. And there is an exemption that is available under section 54 to 54GB, where if the long-term capital gain has been invested in specified assets, then long-term capital gain will be exempt, and unexempted long-term capital gain will be chargeable to tax in respect of the assessee for the previous year. This is exception to section 45 subsection 1. The second exception, section 45 subsection 1 capital B. Section 45 subsection 1 capital B is what? Section 45 subsection 1 capital B is 1 capital A we have discussed. 1 capital B is any section 45 subsection 1 capital B. 1 capital B is any profits or gains arising from the conversion of stock in trade into capital asset. If the stock in trade has been converted into capital asset, then the profits or gains will be chargeable to tax, not in the year in which the stock in trade is converted into capital asset, but the year in which the capital asset has been sold. The capital asset has been sold by the assessee. Stock in trade is not any profits or gains arising from conversion of capital asset into stock in trade. Capital asset into stock in trade, but capital asset has been converted into stock in trade. Then in that situations, it will be chargeable to tax, not in the year in which the conversion has taken place, but the year in which the stock in trade has been sold by the assessee. Then it will be chargeable to tax. There are two types of incomes that will arise. That is capital gain income and profits and gains from business or profession income. First we will discuss about capital gain income. Here in this case, the capital gain income, how we have to calculate? Here we have defined the full value of consideration. Full value of consideration is nothing but what is full value of consideration? Full value of consideration includes the fair market value of the capital stock in trade on the date of conversion of capital asset into stock in trade is full value of consideration for the purpose of income tax. This is full value of consideration. From this, we have to reduce what? We have to reduce cost of acquisition or indexed cost of acquisition, and cost of improvement or indexed cost of improvement, as the case may be. We have to reduce. Then we will get capital gain. This is first part. Second part is what? Second part is relating to what? Second part is relating to sale of stock in trade. If the stock in trade has been sold by the assessee, any sale consideration that has been received on sale of stock in trade will be the sale value. From this we have to reduce the cost. Cost is what? Cost is the fair market value of stock in trade that is convertible from capital asset to stock in trade is the cost. From sale consideration we have to reduce cost. Then we will get the profits. These profits or gains will be taxable under the head profits and gains from business or profession. And this is the process in respect of conversion of capital asset into stock in trade. And there is another section, that is section 25(4)(a), which deals with 25(6)(a), which deals with what? Which deals with any profits or gains arising from conversion of stock in trade into capital asset. Means here, if the stock in trade is converted into capital asset, the profits or gains arising from conversion of stock in trade into capital asset will be chargeable under the head profits and gains from business or profession. Section 2, subsection 24, clause 12, clause 12A, section 2, subsection 24, clause 12A will includes the income will also includes the income that is income that has been mentioned under section 2 subsection 22 section 28 6a. Section 28 6a. So how we have to calculate the income? Here in this section the income has to be calculated as follows. So here when the stock in trade is converted into capital asset, here the fair market value of capital asset on the date of conversion will be taken into consideration. From that we have to reduce cost of acquisition of stock in trade. Then we will get gains that will be chargeable to tax under the head of profits and gains from business or profession. And the second category is what? Second category is when the capital asset has been sold by the assessee, the sale considered full value of consideration includes the fair market value of the sale value of capital asset in the year in which the sale has happened. From that we have to reduce cost. Cost is what? Cost is the capital asset, fair market value of capital asset on the date of conversion of stock in trade into capital asset is the cost. If the period of holding is more than 12 months, or if it is long term capital asset, then it will be indexed to cost of indexation will be applicable as the case may be. Then we will get the gain, that is capital gain, that will be applicable in this case. In this case, obviously we have discussed all the important points relating to conversion of capital asset into stock in trade and conversion of stock in trade into capital asset. Now this is section 45 1 capital B. Next section 45 subsection 2. What is section 45 subsection 2? Section 45 subsection 2 is any profits or gains arising. So we will discuss about section 45 subsection 5 capital A. Section 45 subsection 5 capital A relates to any profits or gains arising from joint development agreement. What is joint development agreement? Joint development agreement is an agreement where the assessee will enter into an agreement with the developer of the property to develop the property, and after developing the property to give any monetary consideration plus any non-monetary consideration to the assessee as the compensation or as a consideration for developing the property, for transferring the rights for developing the property. This is joint development agreement. And the joint development agreement, here any profits or gains arising from the joint development agreement will be chargeable to tax under the head capital gains, not in the year in which the transfer took place. Here this is transfer because section 2 section 47 also includes transfer of rights or enabling enjoyment of immovable property will also include in the definition of transfer, section 2 section 47. So here in the similar manner once it falls under the definition of transfer, capital gain will arise. It will fall under the capital gain will arise. So here under joint development agreement, first we have to consider the full value of consideration. What is full value of consideration? Full value of consideration includes how the full value of consideration has been defined. Full value of consideration has been defined as follows. That is fair market value of the capital asset that has been received by the assessee during the previous year plus the monetary consideration that has been received by the assessee during the previous year. This is full value of consideration. From this we have to reduce what? We have to reduce cost of acquisition. Cost of acquisition or index to cost of acquisition is cost that is incurred by the assessee as the case may be, and cost of improvement or index to cost of improvement. Then we will get capital gain. If here the thing is this capital gain will arise only when the assessee has transferred the monetary consideration or non-monetary consideration after date of completion certificate that has been issued to the assessee. Here date of completion certificate. Before date of completion certificate, the asset will not comes into capital asset will not comes into existence. It is only works contract. After the date of completion certificate, capital asset will comes into existence. So it will be chargeable under the head capital gains. Here if there might be situation where the assessee might receive the monetary consideration and some part of non-monetary consideration before the date of signing of before date of completion certificate that has been issued by the competent authority. Then in that situation In that situation also, any gains or profits or gains arising from that will be chargeable under the head under the profits and gains, but not under the capital gains, because at that time there is no capital asset that existence. So monetary consideration plus fair market value of capital fair market value of the non-monetary consideration that has been received. From that we have to reduce cost of acquisition. Then we will get profits or gains will be chargeable under the head capital under the head profits and gains from business or production. And this is a joint development. This is joint development agreement related situation. And any compensation here, the thing is any compensation that has been this is joint development agreement, and here TDS under section 194 LC, any 194 IC, sorry. So TDS under 194 IC will be deducted under joint development agreement. TDS is the 10%, TDS rate is 10%, and now we will go to section 45 subsection 5. Section 45 subsection 5 is what? Section 45 subsection 5 is any profits or gains arising from we have seen joint development agreement, and any profits or gains arising from compulsory acquisition of the capital asset, say immovable property, will be chargeable to tax in the year in which the compensation has been received, but not in the year in which the compulsory acquisition has taken place. Here compulsory acquisition will include in the definition of transfer under 2 subsection 47. So here how the capital gain will has to be calculated. Here any compensation that has been here immovable property. So when we comes to the definition of property, here we have forgot to discuss some of the important points relating to capital asset. And here any gold articles or any silver articles or any other valuable items precious articles, precious stones will be considered as capital asset as per relevant case law. And here any silver items will not be considered as capital asset as per relevant case law. And any personal effects relating to the assets will not be considered as capital asset. And if the car is utilized for the business purpose, it will be considered as capital asset. And here property, property includes land and building. Land, when we come to land is non-depreciable asset. Land can be two types, that is rural agricultural land or urban agricultural land. Rural agricultural land transfer or sale of rural agricultural land or compulsory acquisition of rural agricultural land will be exempt under 10 subsection 37. 10 subsection 37 it is exempt. And in respect of section 54B also, compulsory acquisition of rural agricultural land is exempt. And in respect of urban agricultural land, what is urban agricultural land? Urban agricultural land has been defined. Here any land, any capital asset that is lying within the municipality limits or cantonment board of having population more than 10,000 but less than or equal to 1 lakh up to 2 kilometers. So more than or equal to more than 1 lakh but less than or equal to 10 lakhs up to 6 kilometers, and more than or equal to 10 lakhs more than 10 lakhs up to 8 kilometers. It is considered as urban agricultural land. In case of transfer of urban agricultural land, in respect of transfer of urban agricultural land, section 50 capital gain will arise. And here TDS under 194 LC is required. TDS under 194 IA is required to be deducted in respect of transfer of immovable property if the consideration is exceeding 50 lakh rupees. If it is less than or equal to 50 lakh rupees, if it is consideration is more than or equal to 50 lakh rupees, then TDS has to be deducted at the rate of 1% of the sale consideration. Sale consideration includes what? Sale consideration includes not full value of consideration that has been received on transfer of capital asset, and it also includes any maintenance charges, any development charges, security, any helper charges, and club membership fees, and society maintenance charges, lift maintenance charges, and security maintenance charges. All these will be included in the category of all this will be included in the full value of consideration for the purpose of deduction of TDS under 194 IA. 194 IA. So this is TDS section, and now we will go to respective we will go to respective section now. So here we have defined this is urban agricultural land. Here what is the rural agricultural land? Rural agricultural land means the land that is utilized by the SSC for the preceding 2 years. So for the purpose of agriculture, then it is treated as rural agricultural land. This is rural agricultural land. Next, up to 50 lakh rupees, even if the transfer of capital asset up to 50 lakh rupees, so no TDS is required to be deducted, but it is chargeable to the capital gains, so chargeable to tax, but TDS will not be applicable. TDS is not required to be deducted if it is less than 50 lakh rupees. If it is more than or equal to 50 lakh rupees, then only TDS is required to be deducted. So you have to be careful. In respect of computation of capital gains. What is full value of consideration? Full value of consideration is in respect of immovable property. Full value of consideration is stamp duty value that is applicable to the immovable property is full value of consideration. When it comes to stamp duty value, section 50C will comes to the play. Section 50C, as per section 50C, if section 50C consists of 3 categories. First one is date of agreement, date of sale, date of agreement and date of sale. If the here if the date of agreement and date of sale is not the same, then in that situation full value of consideration will be the stamp duty value that is applicable on the date of agreement if some amount has been received by the assessee as advance as an advance in other than cash, that is by account pay check or account pay demand draft or electronic clearing system through bank account or any other electronic mode. Any electronic clearing system to bank account or any other electronic mode, then in that situation it is considered as a full whatever the stamp duty value that is applicable on the date of agreement will be considered as full value of consideration. Otherwise whatever the stamp duty value that is applicable on the date of sale or date of agreement or date of registration will be full value of consideration. Otherwise any amount that nothing has been received on the date of agreement, then whatever the stamp duty value that is applicable on the date of registration will be the full value of consideration. So here we have discussed about full value of consideration. From this we have to reduce cost of acquisition or indexed cost of acquisition as the case may be, or cost of improvement or indexed cost of improvement as the case may be. Then we will get capital gain. Here if it is related to compulsory acquisition of immovable property, then we will be getting compensation, right? It is opposite to section 45 subsection 1. So here compensation can be received either in full form, either in part form, that is in the form of installments. So compensation, there can be enhanced compensation as well. So here compensation, when the compensation has been received, the first installment that has been received by the assessee, on that date only we have to calculate the capital gains. And full value of consideration includes the entire compensation amount, not the first installment amount. Entire compensation amount has to be taken as full value of consideration. From this we have to reduce the cost of acquisition or indexed cost of acquisition, and we'll get the capital gain. And in respect of second and subsequent installment, here the cost of acquisition. What is cost of acquisition here? Cost of acquisition is not the cost of acquisition that has been incurred by the assessee. Cost of acquisition is the fair market value of the capital asset. On the date of compulsory acquisition is cost of acquisition, and period of holding is from the date of acquisition of immovable property till the date of compulsory acquisition. Till the date where property has been compulsorily acquired by the government is period of holding. Next, in respect of second and subsequent installments, full value of consideration includes compensation that has been received in respect of second and subsequent installments will be included full value of consideration. From that we have to reduce cost of acquisition. Cost of acquisition is obviously cost of acquisition will be nil, because entire cost of acquisition has been taken in the first installment itself for the purpose of computation of capital gain. Here it will be nil, and we will get the remaining amount as capital gain, and it will be chargeable to tax at the respective rates depending. At the respective rates. Now we will go to enhanced compensation. If enhanced compensation has been received by the assessee, then this enhanced compensation will be chargeable to tax. If chargeable to tax in the year in which enhanced compensation has been received. If any expenses that has been incurred on getting of enhanced compensation, or on procuring or acquiring of enhanced on receipt of enhanced compensation, these expenses has to be reduced. Means here directly attributable expenditure, enhanced compensation, full value of consideration includes enhanced compensation, amount of enhanced compensation that has been received. From this we have to reduce what? We have to reduce From this we have to reduce what we have to reduce any cost or expenses that has been incurred on receipt of enhanced compensation. Then we will get net consideration. From this net consideration there is no cost of acquisition. There is no cost of acquisition. Cost of acquisition will be nil, and entire amount will be chargeable to tax. Here, if any interest that has been received on delay in receipt of enhanced compensation, this interest will be chargeable to tax under the head income from other sources. And here the category is income from other sources under section 57. 50% of the interest will be allowed as reduction, and remaining 50% is chargeable to tax under the head income from other sources. And any compensation or any award that has been received under the award that has been received on compulsory acquisition of immovable property relating to some specified act, that is RTCT LLER something act 2005, then it will be exempt. It will be exempt. It will not be taxable. It will not be taxable. Next, in respect of this is section 45 subsection 5. Next, we will go to important section 45 subsection 3. Section 45 subsection 3 is what? Section 45 subsection 3 is any capital asset, any profits or gains arising from the transfer of capital asset by the partner or member of the association of partner of member of the firm or association of persons or body of individuals to the partnership firm or association of persons or body of individuals, then it will be chargeable to tax not in the year in which such a transfer took place, but in the year in which such amount is recorded in the books of accounts. Such amount is recorded in the books of accounts, it will be chargeable to tax. Here what is full value of consideration? Full value of consideration means the amount that is recorded in the books of accounts of the assessee will be the full value of consideration. From this we have to reduce what? We have to reduce cost of acquisition or indirect cost of acquisition that has been incurred by the partner or member, as the case may be. Then we will get capital gain. This capital gain will be chargeable to tax. This is simple concept. Simple concept. Next, section 45 subsection 4 and 9b, section 9b, and rule. What is the rule that is will be applicable here? Rule 8 8AB. So here section 45, section 9B. What is section 9B? Section 9B is any profits or gains arising from the transfer of the capital asset or stock in trade to the partner, specified person includes the partner or member of from the specified entity. Specified entity includes a partnership firm or association of persons or body of individuals on account of any dissolution or reconstitution of firm will be chargeable to tax as deemed income in the hands of specified entity, that is in the hands of the partnership firm or association of persons or body of individuals, as but not in the hands of the specified person. This is section 9b. Section 9b. Here when we talk about section 9b, Section 9b, here under section 9b, whatever the amount of here full value of consideration includes what? Full value of consideration includes whatever the amount that has been received by the partner or member, and the fair market value of stock in trade or capital asset. Fair market value of stock in trade or capital asset that has been received by the partner or member of member, as a case may be. This is full value of consideration. From this we have to reduce what? We have to reduce cost of acquisition. From this we have to reduce cost of acquisition. Cost of acquisition is the cost of the amount that has been book value that has been recorded in the books of accounts. This is cost of acquisition. Then we will get book profit, that is chargeable to tax as deemed income in the hands of that will be chargeable to tax as deemed income in the hands of partnership firm or association of persons or body of individuals. This is section 9b. Now, what is section 45 subsection 4? Section 45 subsection 4 is any profits or gains arising from the transfer of the capital asset or money, only capital asset to the specified persons, that is a partner or member of the specified firm, that is partnership firm or association of persons or body of individuals, will be considered as deemed income on account of reconstitution, and it will be chargeable to tax in the year in which such receipt of capital asset by the member or by the partner of the specified entity, that is a partnership firm or association of persons or body of individuals. Here one thing you have to remember is here how we have to calculate the capital gain. capital gain. Here full value of consideration includes obviously how you have to calculate capital gain. Here A is equals to B plus C minus D, the formula that has been given under the respective rules. A is what? A is the capital gain that is arising from the transfer of capital asset from the specified firm to the specified firm to the specified entity to the specified person. And here A is what? A is a full monetary value of consideration that has been received, or money value of consideration that has been received by the specified person from the specified entity. B is what? B is the fair market value of capital asset that has been received by the specified entity from specified person from the specified entity. Minus C is what? C is the capital balance that is lying in the books of accounts of specified entity. C here any increase on account of revaluation, three items. Any increase of capital balance on account of revaluation, on account of self-generated goodwill or self-generated intangible assets, on account of self-generated goodwill or any other self-generated intangible assets will not be considered, will have to be ignored. Means these three assets will have to be ignored. And here this is full value of consideration. This is a capital gain that will be arisable. Means here if the transfer, if the asset that is transferred by the specified entity to the specified person is capital asset, then it will be chargeable to tax under the head under the section 9B and section 45 section 4. Double taxation is going to arise. Same capital asset is taxed twice in the hands of in the two different sections. So in order to avoid double taxation, CPDT by circular has introduced Rule 80AB. What is Rule 80AB? Rule 80AB is what is Rule 80AB? Rule 80AB will be as follows. Means if any capital asset that has been received by the specified person from the specified entity on account of reconstitution of the firm, then any gain that is arising on the transfer of the capital asset, which is unrealized gain in the hands of partnership, in the hands of the specified entity, but it is this unrealized gain will be attributable to the remaining specified assets that are lying with the entity, with the entity, and it will be this will be allowed as a deduction against the sale consideration, future sale consideration, when those other specified assets has been sold by the entity, specified entity, by the specified entity. So this the Rule 80AB. This is Rule 80AB. This Rule 80AB is divided into three categories. First category is attributable. Attributable category is Rule 80AB sub Rule 2, and not attributable category is Rule 80AB sub Rule 3 and Rule 80AB sub Rule 4. Sub-rule 4. When we discuss about Rule 80AB sub-rule 2, attributable situation. For example, a capital asset has been transferred by the specified entity to specified person. Then in that situation, rule section 9B will comes into play, and section 45 section 4 will comes into play. So as per section 9B, what is the amount of capital gain here? Profits or gains? First we will take into consideration of the fair market value of capital asset. From that or revaluation, fair market value or revaluation of capital asset. From this we have to reduce book balance of the capital asset. Book balance of capital asset. Then we will get book profit. Okay, this is book profit. Now this is book profit. Next, second one is what? Second one is under section 45 subsection 4, we will take into consideration of A is equals to B plus C minus D. That is monetary value of consideration plus and fair market value of capital asset. From this we have to reduce what? We have to reduce capital balance. Means fair market value of capital asset minus capital balance. Then we will get capital gain. This capital gain has to be this capital gain has to be attributed to the remaining capital assets. Means remaining capital assets balance. If the remaining capital assets, if there is an increase in the value of remaining capital assets, this increase in the proportion of increased value of remaining capital assets, this capital gain has to be distributed to remaining capital assets. As a result, the remaining capital assets value will be increased when those remaining capital assets has been sold by the assessee. Sold by the specified entity in the respective previous years. Then this increased balance will be reduced from will not be taxable again, and it will be reduced from the sale consideration. So this is the process that will be happening in case of Rule 8AB sub rule 2. If it is attributable case, if it is not attributable case, is what? Not attributable case has been given under Rule 8AB sub rule 3 and Rule 8AB sub rule 4. If any money value of consideration that has been transferred, if any only money value of consideration that has been transferred, then in that situation Rule 8AB money value of consideration that has been transferred, then section 9b will not comes into play. Only section 45 subsection 4 will comes into play. Then in that situation, capital gain that is arising under section 45 subsection 4 we will calculate, and it is not attributable. If it is not attributable, in respect of not money value consideration, not if it is not attributable, there is no capital asset that is lying with the assessee. There is no capital asset that is lying with the assessee. It is not attributable to any other assets. Then in that situation, it is not attributable case. Then in that situation what happens? Then in that situation we will allocate the balance to the capital, allocate the gains to the capital balance. Means here whatever the gain that is arising under section 9b or under section 9b or 45 subsection 4 will be attributable to capital balance. How it will be attributable to capital balance means will be transferred to capital balance. How it will be transferred? Here first under section 9b. Under section 9b we will be getting right. How we will calculate capital gains under section 9b. First we will take full value of consideration, that is fair market value of the capital asset that has been transferred. From that we have to reduce the book value of the capital asset. Then we will get book profit. From this book profit we have to reduce tax, if any tax that is applicable to the suicide entity we have to reduce. We will get net book value, net book profit after reducing the tax. This net book profit after reducing the tax has to be distributed to the remaining partners in their profit sharing ratio. Once you have distributed, then we will get the share of the partner of the net book profit after reducing the tax. This share has to be added to the capital balance. Now we will shift to what? We will shift to section 45 subsection 4. Under section 45 subsection 4, we will calculate the capital gain as A is equal to B plus C minus D. B is a monetary value of consideration, money value of consideration that has been received, and C is the fair market value of capital asset that has been received, and D is the capital balance. B, fair market value of capital asset that has been transferred. From this we have to reduce what? We have to reduce capital balance. Capital balance will also includes the share of the profit after reducing the tax under section 9b. We have to reduce, then we will get the net capital. We have to add to the capital balance, and this full value of capital balance has to be reduced from the fair market value of capital asset. Then in that situation, the net capital gain will be taxable under income tax act. So in this way we can avoid double taxation. In respect of if it is not attributable case. If it is not attributable case, means there might be a situation where it is not attributable to any of the capital assets, that are lying with the assessee. Then in that situation also the same process will be followed. In two situations. Next, the capital gain that is arising in this category is whether it is short-term capital gain or long-term capital gain. If it is related to depreciable assets, or if it is related to depreciable assets, or it is related to royalty or any stock in trade, then it is short-term capital gain. And any short-term capital asset, and if it is related to on account of this short-term capital gain, and short-term capital gain will be chargeable tax under respective rates. If it is if it is falls under other category, then it is long-term capital gain. It will be chargeable under respective rates. This here capital asset can be either depreciable asset, non-depreciable asset. If it is non-depreciable asset, then section 48 will comes into play. As per section 48 subsection 3, we have seen all this computation under section 48 subsection clause 3, 48 clause 3. And if it falls, if it is depreciable asset, it will section 43 subsection 6 clause B will comes into play, and section 50C will 50 and computation will becomes takes as per section 50C. Section 50C. Here from the sale consideration or fair market value of capital asset, we have to reduce the capital balance, that is book value, carrying value of the asset relating to block of assets. We have to reduce. Then net amount will be chargeable to tax under the head capital gains. As the case may be. Here this is a process in respect of section 45 section 4 and 9 capital B, and rule 8 characterization of tax rule 80A and rule 80AB attributable and non-attributable cases. Next, this is now we will discuss about section 45 subsection 2. We have discussed section 45 subsection 2 capital. Section 45 subsection 2 capital A. So section 45 subsection 2 capital A is what? Section 45 subsection 2 capital A is any amount that has been received on transfer of any amount that has been received on transfer of any shares or any specified securities. Any shares or any specified securities will be chargeable tax in the year in which such transfer took place. Section 45 subsection 2 capital A. Something is missing. I think I have to revise this again. Next we will go to what? We will go to next category of sections. Next category of sections is capital gain or capital gain that are arising from the specified assets. Specified assets includes what? Here section 46, section 46A. Section 46 is buyback. Section 46 is what? Section 46 is liquidation of the company. Here, in case of liquidation of the company, it will be divided into two categories. That is for section 40 subsection 1, section 46 subsection 2. Section 46 subsection 1 is relating to when the company has transferred the capital assets to the shareholders on account of liquidation. Then in that situation, it will not be chargeable in the hands of company because liquidation is not considered as transfer under section 2 subsection 47. Now we will go to section 46 subsection 2. Under section 46 subsection 2, any assets that have been transferred under section 46 subsection 2, any assets that have been transferred by the any asset that has been received by the shareholders on account of transfer, then it will be chargeable under the head capital gains in the year in which such transfer took place. And here full value of consideration is what? Full value of consideration is fair market value of capital asset that has been received by the shareholders and money value of consideration that has been received by the shareholders. From that we have to reduce cost of acquisition. Cost of acquisition is the dividend that has been distributed by the company. Company up to the year of liquidation. Is considered as a deemed dividend under 2 subsection 22 clause C. We have to reduce. Then we will get capital gain. This capital gain, depending upon period of holding is from the date of purchase of securities till the date of completion of liquidation is period of holding. If it is this is relating to securities, right? Then 12-month bucket will be applicable. If it is less than or equal to 12 months, then it is a short-term capital gain and short-term capital asset, short-term capital gain. If it is more than 12 months, then it is long-term capital gain, long-term capital asset, long-term capital gain, as the case may be. And if it is related to unlisted equity, unlisted shares, then 24 months bucket will be applicable, not 12-month bucket. And if it is related to listed equity shares, then 12-month bucket will be applicable. Next, this is liquidation related the thing, and liquidation related thing. Next comes to section 46A. Section 46A related to buyback of securities by the company, whether listed company or unlisted company. If the company has buyback its shares, then in that situation, what are the capital gain implications? Here, in respect of buyback of shares, in respect of company, if the company has bought back its shares from the shareholders, then company is required to pay tax at the rate of 20% of tax plus 12% of surcharge plus 4% of health and expenses. Entire effective rate comes out to be 23.966944% will be the effective rate of tax that is paid as additional tax by the company itself. Once the company has paid the tax, then it will be exempt in the hands of shareholders. In the hands of shareholders, it will be exempt under 10 subsection 43. 10 subsection 43, it will be exempt in the hands of shareholders. Next. It will be exempt in the hands of shareholders. So if the buyback of securities is on account of any other mode or by any other entity, then it will not be taxable in the hands of company. In the hands of company, it will be exempt. It will be taxable in the hands of shareholders only. It will be taxable in the hands of shareholders only on receipt of buyback proceeds. It will be taxable in the hands of shareholders. That is cost of full value of consideration minus cost of acquisition. Full value of consideration is the amount that has been received on account of buyback of securities. Cost of acquisition is the cost of acquisition that has been incurred by the assessee for acquiring of those securities. Then we will get the capital gain that is applicable that is chargeable to tax depending upon the period of holding. Now next concept is what? Next concept is in respect of in respect of the following categories. The first one is demerger, second one is amalgamation. Demerger is what? Demerger situation is there is a company which has been where it consists of 3 units, unit 1, unit 2, unit 3, and if unit 3 has been sold to unit 3 has been transferred as a separate listed entity, this is the resulting company. Then in that situation, it will not be considered as it will be considered as transfer because enabling enjoyment of rights has been transferred, so it will be considered as transfer under 2 section 47, but it will not be considered as transfer under section 47. If it is not considered as transfer, it is exempt from tax. It is exempt from tax. So in that situation, because why it is exempt, it is not considered as transfer means any fresh consideration is not received by the shareholders. It is only the splitting up of existing assets in one book to another asset in another book. So it is transferring of one asset books in one asset to one asset in one book to asset in another book. So there is no fresh consideration that has been received, so no capital gain will arise. So it is not considered as transfer. And what is and if the resulting company has issued shares, if the resulting company has issued shares, these shares will be received by the shareholders of demerged company, and any shares that has been issued by the shares of demerged company, the shareholders of demerged company will not be considered as transfer, and it will be exempt because no fresh consideration has been given by the shareholders to the resulting company for the purpose of issue of shares. So there is no fresh capital movement is happening. It is only book adjustment. So it will not be considered as a transfer under section 47. And in respect of two other types of capital gains, where a foreign company which is a demerged entity will transfer the capital asset to another foreign company which is a resulting company which is, and here capital asset is relating to an Indian company. Then in that situation it is tax, it is not considered as transfer under section 47. And any share that has been issued by the shareholders of the Indian company, shareholders who are relating to India, shareholders will not be considered as transfer under section 47. And if the foreign company, if there is a foreign company and this foreign company has transfer, the foreign company means what is the definition of foreign company? Foreign company means a company other than Indian company is foreign company. And if the foreign company has transferred a capital asset to another foreign company which is the resulting company, and this capital asset is relating to not the Indian company, but the foreign company has hold substantial rights in the Indian companies that are located in India. Then what is Indian company? Indian company means Indian company has been defined under the Act. Indian company means a company which is incorporated under Companies Act 2013, or company which has made arrangements for declaration of dividend. It is an Indian company. Indian company. Then if it is an Indian company, if it is relating to the rights or substantial holding of substantial rights of Indian company, then it will not be considered as transfers under section 47. And any shares that have been issued by the resulting company, resulting company will not be considered as transfer under section 47. Next, here how we have to calculate the cost of acquisition of the cost of acquisition of resulting company. Cost of acquisition of resulting company is cost of acquisition of demerged company into assets that have been net book value of assets that have been transferred to resulting company divided by net worth of the company. Net worth of the company, how we have to calculate net worth of the company? Net worth of the company is equal to paid up share capital plus free reserves. This is net worth of the company. And what is the net book value? Here cost of acquisition of the assets of demerged company. Cost of acquisition of assets of demerged company is equal to cost of total net worth of the company minus cost of acquisition of shares of demerged company before demerger minus cost of acquisition of resulting company. Resulting company, and there are some specific conditions that need to be satisfied in respect of this also. Next, now we'll go to second category, amalgamation. In respect of amalgamation, what happens in the case of amalgamation? An amalgamating company will be transferring the capital assets to amalgamated company in the scheme of amalgamation. Here in respect of demerger, any brought forward losses that are relating to the resulting company will be carried forward for the remaining period in the case of demerger. But in case of amalgamation, the case is reversed. That is, in respect of amalgamation it will not be considered as a transfer, because there is no fresh capital movement that is happening. It is only shifting of assets from one book to another book. So one book of companies to another book of companies. So it will not be considered as transfer. And any shares that have been issued by the amalgamated company to the shareholders of amalgamating company will be exempt. Will not be taxable under the head capital gains, because it is not considered as a transfer. And here, what is the cost of acquisition? Cost of acquisition of amalgamated company is cost of acquisition of amalgamating company. And here any losses relating to amalgamating company will be carried forward by amalgamated company for the fresh period of 8 years. No need of carry forward of losses for the remaining period. Fresh period of 8 years will be provided. And in respect of depreciation will be bifurcated between amalgamating company and amalgamated company, depending on period of holding of assets. And here the conditions need to be satisfied by the amalgamating company and amalgamated company. Amalgamated company, 3/4 of the value of assets has to be held by the amalgamated company after the amalgamation. And business has to be continued for a period of not less than 5 years by the amalgamated company. And all the shareholders of amalgamating company will be the shareholders of amalgamated company. More than 90% of the shareholders of amalgamating company should be the shareholders of amalgamating company. And the amalgamated company, and in respect of conditions of amalgamating company, here amalgamating company should carry out business for 2 years or more, and amalgamating company should have assets which are more than or equal to 3 years, held by the assets more than or equal to 3 years. These are the conditions of amalgamating company, and it should be for genuine business purposes. Amalgamation should be for genuine business purposes. Then only this all these exemptions, all these benefits that are available in respect of amalgamation. And if any asset that have been transferred in the future years, or if the business has been discontinued by the amalgamated company, and whatever the losses that have been carried forward, losses that have been allowed to be carried forward, and whatever the transfer capital that has been happened, this will be entirely chargeable to tax under the head capital gains as deemed income. And next, in respect of corporatization of stock exchange, that is, if there is association of persons of stock exchange, the stock exchange association of persons, members of association of persons relating to stock exchange have transferred their rights to the stock exchange, and have received the trading rights from the stock exchange, which is corporate, which is a corporate person. Then in that situation it will not be considered as transfer, because there is no fresh movement of capital happening here. Only the form of the entity is changing from association of persons to corporate person. So here corporate person. So it is not considered as transfer. No capital gain will arise. Next, we will go to the specified securities. Transfer of specified securities. That is transfer of right shares. Right shares are what? Right shares means if the shareholder receive the right shares from the company, then there are 3 categories. First category is rights entitlement. That is subscription to right shares. If the shareholder has subscribed to the right shares, then in that situation, cost of acquisition is purchase price of the shares. Purchase price of right shares is cost of acquisition. If he has not subscribed to right shares, but he has renounced the entitlement of right shares, if he renounced the entitlement of right shares, then cost of acquisition will be nil for him. And if the third party has purchased the right shares, then in that situation, cost of acquisition is cost of acquisition of purchase price of shares that has been incurred, purchase price of right shares plus cost that has been incurred on renunciation of rights. Amount that has been paid for renunciation of rights is that cost of acquisition. In respect of bonus shares, 2 categories. First category is if the bonus shares has been issued before 1/4/2021, then in the 1/4/2001, then in the situation the fair market value of bonus shares on 1/4/2001 will be considered as cost of acquisition. If the bonus shares has been issued on or after 1/4/2001, then the cost of acquisition will be considered as nil. In respect of in respect of intangible properties, in respect of any rights, in respect of any loom hours, in respect of any right to manufacture the thing or article, in respect of stage carriage permits, in respect of stage carriage permits, and in respect of any other rights, or rights of intangible nature, the any in respect in this categories, if it has been acquired by the assessee, then it is purchase price. If it is not acquired by the assessee but it has been received by the assessee under any other modes, then in that situation it will be cost to the previous owner. If it is under any other category, it falls under any other category, then it will be the cost of acquisition will be considered as nil. Cost of acquisition will be considered as nil. Then we'll go to redemption of zero coupon bonds. In case of redemption of zero coupon bonds, zero coupon bonds will be considered as a capital asset, and period of holding will be 12 months but not 24 months or 36 months. If it is less than or equal to 12 months, then it is short term capital asset. If it is more than 12 months, then it is the long term capital asset. And zero coupon bonds, the consideration that has been received on redemption of zero coupon bonds will be as full value of consideration. From this, cost of acquisition will be what? Cost of acquisition is a purchase price that has been incurred. On acquisition of zero coupon bonds will be the cost of acquisition to the assessee. Then we will get the capital gains that will be chargeable to tax. Now we will go to obviously. Section 50B, we have what are the remaining sections that we need to section 54 EC we have to section 54 EC we have to discuss. Section 54 EC, what section 54 EC is investment made by the assessee in specified bonds. Here assessee is what? Assessee is any person. Any person means person has been defined under 2 section 31 of the Income Tax Act. Here it can be resident or it can be non-resident. And resident or non-resident means depending upon the residential status. Section 5, section 6 and section 6 subsection 1, section 6 subsection 1 capital A, section 6 subsection 2, section 6 subsection 3, section 6 subsection 4. All this comes into play in terms of resident and non-resident category. Now what is the capital asset? Capital asset is long-term capital asset. Long-term capital asset has been defined under 2 section 24 long-term capital asset. And if it is a long-term capital asset, transfer is long-term capital asset. And here what is the investment that has to be made? Investment has to be made in 4 types of bonds. That is 4 types of bonds that are whose maturity is more than or equal to 5 years. Those are more than 5 years. That is rural electrification bonds and REC bonds and National Highway Authorities of India bonds and IRFC. Indian Railway Finance Corporation Limited bonds and Power Finance Corporation Limited bonds, and these bonds amount of investment that can be made is maximum up to 50 lakh rupees. If it exceeds 50 lakh, what is the period within the specified period? What is the specified period? Specified period is within a period of 6 months from the date of transfer of capital asset, or from the date of transfer of capital asset within a period of 6 months, the investment has to be made. If the investment has been made, what is the amount of capital gain exemption that is available to the assessee? What are the amount of investment that has been made or capital gain, whichever is lower, will be allowed as the exemption. If the assets have been, if the bonds has been transferred or redeemed by the assessee before expiry of this lock-in period or specified period, then in the situation, what are the capital gain that has been exempted for the assets will be taxable in the year in which such a sale or such redemption took place. And next, this is section 54 EC. So we have discussed obviously the all important provisions. What we are left with section 50B, that is slum sale category, and section 43 CA relating to profits and gains from business or profession, and section 50C, 50CA, and we are left with section 51, that is advance money that has been received section 51. Next section 50. Section 48, we are left with section 48, and we are left with section 54 series. Section 54 series we are left with. We will discuss in the later stages. We will discuss all these important topics. Okay, thank you. Bye bye.